What's up, everyone? Get locked in with me for a moment. Silence every possible distraction. Shut down every other window, because what I'm going to lay out for you will fundamentally alter your perception of the current situation in the silver market. This isn't guesswork. This isn't a hypothesis. This is recorded activity from one of the planet's largest economic powers, activity that reveals a predicament so severe that authorities had no choice but to enact urgent controls. And if you fail to grasp the true significance of this move, you are on the verge of misinterpreting the most powerful message the precious metals sector has sent us in more than 10 years. As we speak, silver is priced at $8,515 per ounce. Gold is holding at $4,918. And before we dive any deeper, you must internalize a crucial fact. These price points are not the peak. They are not even in the vicinity of true fair value. They represent the active arena where a battle for dominance is being waged in real time. Because while you've been monitoring graphs and reviewing your holdings, an event with no precedent just occurred. The Chinese government, without any advance notice and without offering any excuses, simultaneously disabled 5 distinct commodity investment funds during a single market session. Not for a few moments, not for a brief pause, a complete trading suspension. The sole silver futures fund accessible to investors on the mainland was sealed shut for a full day. 4 additional funds concentrated on oil were frozen at the same time indefinitely. This was not scheduled upkeep. This was not a technical error. This was a crisis maneuver reacting to what officials publicly labeled a systemic threat and the immediate potential for enormous investor losses. Here is what distinguishes this event from typical regulatory moves. This marks the second emergency shutdown in just over a week. Whatever solution they believed they implemented on January 22nd plainly did not last. The issue returned with such force that they were compelled to hit the emergency stop button once more. When the globe's second-largest economy begins activating emergency trading freezes because commodity demand has spun wildly beyond their management, you cannot casually dismiss it as standard procedure. You cannot simply say, "That's just how China operates," because the events unfolding there are a direct mirror of tensions mounting universally, and that tension is on the verge of flooding into new channels. I'm going to demonstrate precisely what those channels are, and, even more critically, how you should situate yourself before the next stage ignites. But before we analyze what this signifies for your financial future, if this kind of thorough, substance-only analysis is providing you understanding that you can't find elsewhere, hit the like button right now so this reaches more viewers. And make sure you're subscribed if you aren't already, because what unfolds in February will distinguish those who are ready from those caught completely unaware. Now, let's meticulously walk through the events, because the specifics reveal the entire narrative. On January 30th, Chinese financial regulators carried out what can only be termed a synchronized emergency freeze across several commodity investment vehicles. The primary focus was the UBS SDIC Silver Futures Fund. This isn't some minor local offering. This is the single publicly available fund in all of mainland China that provides direct investment in silver futures. The only one. Ponder that for a second. A population of 1.4 billion people effectively has one regulated avenue for silver futures exposure, and that single avenue was shut down for a whole trading day. That is not ordinary market oversight. That is panic containment. And the situation deteriorates further. At precisely the same moment, 4 oil-centric listed open-ended funds were struck with coordinated suspensions, frozen until 10:30 a.m. Beijing time. The synchronization is the key clue. When regulators act on multiple funds simultaneously across different commodities, they are not addressing a minor, isolated glitch. They are confronting a systemic failure. So, what failed? What compelled them to act? Premiums. Specifically, the widening chasm between what investors were paying for shares in these funds and the actual worth of the assets they represent. And the figures are staggering. The UBS SDIC Silver Futures Fund was trading at a 36% premium above its net asset value. Let me repeat that so it fully sinks in. Investors were paying 36% more than the underlying silver futures were actually worth, just to gain exposure through that fund. Here is the real-world implication of that. If you purchased shares at that inflated premium and the price of silver futures remained completely static, you would still be facing an instantaneous 36% loss the moment that premium returned to normal levels. You weren't purchasing silver, you were purchasing desperation. You were purchasing the fear of missing out at literally any cost. Retail investors in China were so frantic for silver exposure that they were ready to pay over a third extra just to enter the market. They weren't inquiring what silver was worth. They were asking how quickly they could establish a position before it surged beyond their reach. Regulators saw precisely where that path was leading. They observed retail capital flooding in at mathematically impossible prices. They watched a dangerous feedback loop take shape. The premium increases. People interpret that as validation. More buyers swarm in. The premium climbs again. Even more momentum-driven investors leap aboard. That is the spiral they chose to halt before it incinerated the entire retail investor base. Not because they despise metals, not because they aim to sabotage the rally, but because when that premium inevitably collapses, and it always does, the resulting losses would be devastating for millions of individuals who didn't even comprehend what they were truly purchasing. Now here is the question almost no one in the financial media is posing. Why was demand that intense to begin with? Why were investors willing to pay 36% premiums instead of merely waiting? Because the answer uncovers exactly where we are positioned in this market cycle. Silver has been on an absolute rampage. In the past month alone, silver skyrocketed 58%. Not 5%, not 15%, 58%. We are discussing prices thrusting toward $118, hitting $58 an ounce at the high, levels that would have seemed utterly irrational just half a year ago. Gold has also been blazing hot, up 22% and nearing $5,600 an ounce. Oil shattered resistance, with Brent crude reaching 5-month highs above $70 a barrel. That is not random chance. That is not simple sector rotation. That is a coordinated stampede into tangible assets, driven by forces that are accelerating, not diminishing. First, monetary policy turmoil. Central banks have been jerking markets between expectations of imminent rate cuts and talk of sustained higher rates. Each time traders price in easier money, the dollar weakens, real yields contract, and metals attract bids. Each time hawkish rhetoric resurfaces, you experience violent retreats. This constant vacillation generates extreme volatility, and leveraged fund products magnify it. Second, geopolitical friction. U.S. naval movements near Iranian waters, tensions across multiple global theaters, supply chains feeling increasingly vulnerable. When traders begin pricing conflict risk into oil and investors start hedging against currency devaluation through metals, demand escalates swiftly enough to overwhelm standard market structures. Third, the structural supply crisis. This isn't merely about spot prices. Silver isn't just a monetary metal, it's industrial muscle. Solar panels consume it, electric vehicles consume it, 5G infrastructure consumes it. The green energy transition is silver intensive, and supply has utterly failed to match demand growth. When monetary demand, safe haven demand, and industrial demand all converge simultaneously, you do not get orderly price discovery. You get violent, explosive moves. And when that entire demand surge is funneled through one singular vehicle serving 1.4 billion people, you get 36% premiums and emergency trading halts. Now I want to demonstrate to you that this is not confined to China. The gold to silver ratio, how many ounces of silver it requires to purchase 1 ounce of gold, has compressed to its most narrow level since 2011. This is not occurring because gold is plummeting. It's happening because silver is aggressively catching up. And historically, that kind of compression signals a major paradigm shift. Concurrently, physical silver demand has been detonating worldwide. One major dealer reported a 158% increase in sales of 10-ounce silver coins and a staggering 550% surge in demand for 1 kilogram bars over the same time frame. Google searches for "how to buy silver" and "buy silver online" jumped 250% in recent months. That is not niche interest, that is a mass awakening. Individuals are seeking exposure outside the traditional financial architecture, and physical accumulation stands as one of the clearest manifestations of that trend. Therefore, when Chinese regulators shut down their only silver futures fund, that demand does not simply vanish, it redirects. Some capital flows into physical silver, some moves into Hong Kong-listed products, some ships into gold, some discovers pressure points in international markets. This is the crucial insight most people overlook. The trading halt did not eliminate demand. It forced that demand to locate new pathways, and every new pathway generates additional strain on global supply chains that are already stretched to their limits. Now, allow me to show you the conclusive evidence that proves the larger setup. Under normal circumstances, if a market is halted or spooked, short sellers swarm in, hedge funds smell blood, algorithmic systems pile on, borrowing demand spikes, and borrowing costs surge. But right at this moment, the borrow fee for SLV, the world's largest silver ETF, is essentially zero, rock bottom. And there are millions of shares readily available to borrow, just sitting idle. Nobody wants them. Nobody is initiating short positions. Do you understand how extraordinary that is? China just triggered emergency halts. The prevailing narrative should be that the rally is finished. Regulators are shutting it down, the trade is overcrowded, and yet sophisticated capital refuses to bet against it. Why? Because they are examining the same data we just walked through. The 58% move in 30 days, the explosion in physical demand, the structural supply deficit, Chinese demand being rerouted into other markets. They understand that shorting silver at this juncture is like stepping in front of a freight train and holding up a paper sign that says, "Stop." That freight train is global demand for hard assets, and if you stand in its path, you do not get wealthy, you get erased. This also informs us of something else. Any perceived weakness we are witnessing is not natural selling. It is not institutions liquidating. It is pressure from a small contingent of bullion banks dumping contracts to maintain price containment, leveraging paper instruments to cap silver and defend the credibility of the dollar. But they are acting alone. The remainder of the financial world is standing back because they comprehend this $85 price is not a ceiling. It's a coiled spring. And the instant that suppressive force loosens, arbitrage activity awakens, and the price can gap upward with violent intensity. Now we must discuss the oil side of this equation because it is interconnected with silver in ways most people completely overlook. China didn't only suspend the silver fund, they struck 4 oil-focused funds at the exact same moment. That coordination is the revealing clue. And on the very day those suspensions were enacted, Brent crude broke above $70 a barrel for the first time in 5 months. While U.S. naval vessels were positioning near Iranian waters, the market was directly pricing a geopolitical risk premium into energy. Chinese investors chased it through oil funds in the same manner they chased silver. Here is the loop regulators were attempting to break. Tensions rise, commodities rise, retail investors chase, premiums expand, premiums become unstable, regulators intervene. But here is the component nobody wishes to state openly. That intervention treats the symptom, not the root cause. The tensions are still present. The supply vulnerabilities persist, the demand remains. Halting trading for a period does not eliminate those forces, it merely compresses them temporarily. That is why I am convinced the oil narrative is far from concluded, and why it corroborates the precious metals narrative, because both are being propelled by the same fundamental driver, a loss of confidence in paper-based systems and a flight into physical assets. Consider what oil and silver share: strategic importance, essential roles in infrastructure, vulnerability to disruption, and paper markets where derivative contracts massively outnumber actual physical delivery capacity. When stress impacts these systems and demand surges faster than supply can respond, people begin to question whether their paper exposure will genuinely convert into physical reality when it matters most. That is when premiums explode. That is when funds trade 36% above NAV. That is when regulators panic. But shutting down trading does not create more oil, it does not create more silver. It merely conceals the supply crisis behind regulatory curtains. And here is what follows. Pressure builds, demand discovers new routes, premiums emerge somewhere else, Hong Kong, Singapore, London, wherever capital can flow. We are already witnessing it in physical premium data, in the compression of the gold-silver ratio, in the steadfast refusal to short even as headlines scream chaos. The smart money understands what regulators are reluctant to admit. You can halt trading, restrict purchases, and impose cooling-off periods. But you cannot suspend the underlying forces driving demand, and you cannot manufacture physical supply with paperwork. So when I examine China's intervention, I do not see the conclusion of the commodity rally. I see confirmation that the rally is powerful enough to threaten systemic stability. And that informs me we are not near the summit. If we were near the top, regulators would not need to intervene. Weak hands would be selling naturally, premiums would compress on their own, the market would find equilibrium without emergency measures. The fact they shut down trading twice in 8 days communicates the opposite. Demand is so relentless that normal market mechanisms cannot process it, and when normal mechanisms cannot process demand, that demand does not disappear. It becomes more inventive. Now, I need to address the obvious concern, because I know some of you are considering it. Yes, silver possesses powerful momentum. Yes, the fundamentals support it. Yes, China's halt demonstrates genuine demand pressure. But markets that advance this rapidly, this forcefully, can also correct sharply. The same volatility that generates 58% gains in a month can produce 30% drawdowns in a week. Some analysts are projecting $150 silver within 3 months. That may occur. But it is also the type of aggressive forecast that tends to emerge when retail enthusiasm is peaking. I am not advising you to sell everything. I am not declaring the rally is over. I am urging you to comprehend our current position. The easy money has been captured. The obvious trade has been executed. What comes next demands greater discipline, more patience, and enhanced risk management. If you are already positioned, this might be a moment to focus on protecting your downside rather than adding to your position at extended valuations. If you are not yet positioned, this might be a time to wait for constructive pullbacks instead of chasing momentum at 52-week highs. Authentic wealth in these markets is built by individuals who buy during fear and sell during greed. And right now, there is a significant amount of greed present in silver. That does not terminate the bull market. It simply indicates the subsequent phase will require more skill than the initial one. But here is what I want you to understand about China's intervention. This is not the finale of the story. It is the commencement of a pattern. When markets become sufficiently heated to threaten stability, regulators step in. They halt trading. They restrict new purchases. They enact what they believe will prevent the retail public from catastrophic losses. That does not mean the underlying trend is incorrect. It means the trend is potent enough to frighten them. And potent trends typically possess more room to advance once the pressure from intervention subsides. History is replete with such examples. Major precious metals bull markets have repeatedly witnessed attempts to cool price action. The 1970s experienced multiple intervention moments. The 2000s rally displayed similar conduct. Interventions created pauses, but they did not erase the foundational forces. I am not claiming history repeats perfectly. I am stating that intervention during a powerful bull market is a normal occurrence. Therefore, if you are using China's halt as your rationale to panic sell, you might be interpreting the signal in reverse. Let me provide you with a framework instead of a prediction, because frameworks preserve you in volatile markets. 1. China's halt is a signal, not an endpoint. It informs you that demand surpassed the system's capacity to process it smoothly. That demand then redirects, builds pressure, and eventually finds a release. 2. Premiums are information. A 36% premium is the market screaming desperation and constraint. You do not need to trade the specific fund to respect the message that premium is communicating. 3. Separate trading from accumulating. If you are a short-term trader, do not chase. Wait for pullbacks. Do not pay excessive premiums for exposure. If you are a long-term accumulator, volatility matters less. You are purchasing the decade-long thesis of currency debasement, relentless industrial demand, and the repricing of hard assets. 4. Watch the physical market. When paper access becomes disrupted, physical metal becomes more attractive. Dealer premiums are critical data. Rising premiums signal the physical market is tightening. Falling premiums indicate supply is catching up. And right now, the physical market is screaming. Dealers are reporting demand patterns resembling panic buying. 158% growth in 10-ounce coin sales, 550% growth in 1 kilo bars. This is transpiring simultaneously with China blocking paper access. That signifies some capital is being compelled into channels that are far harder to suppress. Physical metal does not have trading halts. Physical metal does not have a fund manager who can disable your buy button. Physical metal is the escape hatch. That is why monitoring dealer premiums is vital. When premiums rise meaningfully above the reported spot price, it signals the paper price is disconnecting from physical reality. It signals people are willing to pay extra to secure actual possession. We are beginning to observe this in certain markets, not universally, not uniformly, but the trend is forming. And if Chinese demand continues migrating into physical routes, those premiums can expand further. That creates a self-reinforcing loop. Regulators restrict paper access. Demand moves to physical. Supply tightens. Premiums expand. Expanding premiums validate the narrative that the paper price is artificial. More people rush into physical metal. You cannot regulate your way out of a supply crisis. You cannot suspend your way out of demand. And you cannot undo decades of underinvestment in mining while industrial consumption accelerates exponentially. 5. Watch the gold-silver ratio. It is one of the most dependable cycle indicators in this entire sector. It is currently in a powerful mean reversion phase. Whether it continues this compression or snaps back will reveal much about our current position in the cycle. Beneath all this market volatility, here is what I believe is truly unfolding. This is a stress test of global commodity infrastructure. Geopolitical strife, monetary policy confusion, and structural demand growth are pushing markets beyond what they were originally designed to handle. China halting funds is one possible response. Other nations may react differently, but the underlying pressure is identical everywhere. And pressure of this magnitude tends to produce the same long-term outcome: repricing. Paper assets that once felt secure begin to feel fragile. Hard assets that seemed outdated begin to feel essential. Fiat currencies that appeared stable begin to feel experimental. Physical commodities that were considered boring begin to feel strategic. This is not a forecast for next week. This is an observation about our position within a multi-decade cyclical shift. The individuals who recognize these shifts early position themselves for a generational transfer of wealth. The individuals who dismiss it as mere noise are left holding devalued paper. So, here is my question for you, and I want to see your answers in the comments. Do you believe China's trading halt is a warning that silver has risen too far, too fast? Or is it confirmation that demand is so potent even regulators cannot contain it? There is no incorrect answer, but your response reveals how you are interpreting this moment, and that shapes your investment positioning. Share your perspective below. And if you have been navigating this rally successfully, please share what strategies are working for you, because real-world feedback from this community benefits everyone watching. Let me leave you with one final reflection. When authorities intervene, they are communicating that the market has grown strong enough to alarm them. And markets alarm authorities only when something fundamental has shifted. The forces propelling precious metals demand are not dissipating. Concerns over currency debasement are not fading. Geopolitical uncertainty is not vanishing. Industrial demand is not declining. Central bank gold accumulation is not stopping. These are multi-year themes, not multi-week trades. And if you are positioned for the long game, the day-to-day noise of intervention becomes far easier to navigate. Here is one more framework to solidify this understanding. Markets progress in cycles: bull phases, bear phases, consolidation, breakouts. Within those cycles, recognizable patterns emerge. Regulatory intervention is one such pattern, and it tends to manifest at specific junctures. Early in a bull market, regulators are indifferent. Price moves are modest, retail participation is low, and there is no systemic fear. But as the bull market matures, prices accelerate, retail capital floods in, leverage increases, and regulators take notice. They observe premiums expanding, they witness speculative chasing, they see risk accumulating. Then they face a decision: let it run and risk a brutal collapse, or intervene now to contain the damage. China chose intervention. They observed a 36% premium and essentially declared, "This has gone too far. We must protect the retail public from itself." That tells you where we are. We are not in the early stage. The easy money has been made. But we are not in the late stage either. If we were late, premiums would be compressing naturally. Smart money would be shorting, and weak hands would be selling into strength. But that is not what we see. Smart money is not shorting. Physical demand is accelerating. The gold-silver ratio indicates silver still has room to run relative to gold, and Chinese demand is already discovering alternative outlets. This is the middle phase of a major bull market, the phase where volatility intensifies, intervention escalates, and weak hands are shaken out. But the primary trend remains powerfully intact. The individuals who build generational wealth are those who do not panic during this middle phase. They are the ones who separate noise from signal. They are the ones who understand that intervention does not equate to invalidation. China's halt is not instructing you to sell. It is informing you that demand is potent enough to frighten regulators. Do not confuse intervention with defeat. Do not confuse temporary halts with trend reversal. Do not allow short-term noise to steal your long-term conviction when the foundational thesis remains fully intact. What's up, everyone? Friday, January 30th, 2026. Silver is at 85.15. Gold is at 4,918. China has just shut down their only silver futures fund for the second time in 8 days. Physical demand is detonating across the globe. The gold-silver ratio is at levels unseen since 2011, and sophisticated capital is refusing to short, despite the apparent chaos. If this detailed breakdown helped you see clearly through the noise, hit the like button, subscribe, and share this with someone who needs to hear this message. Stay alert. Do not let the noise of intervention shake your core conviction. I'll see you in the next one.